Hello, everybody. My name is Susanna Lam from InnoCham, and today I'm going to be continuing my discussion about U.S. tax brackets. So let me go ahead and share screen with you. Sorry, somebody's calling me. All right. So can you see my screen? Yeah, all right. So common individual tax brackets is going to be the discussion for today. So before we get into the nitty-gritty detail of what all this is about, I want to again read to you the disclaimer. So I'm just going to let you read it. I'm going to give you about maybe 5-10 seconds to read it. But basically what I'm sharing with you is for educational purposes only. And this is not meant to be a financial advice or nor tax advice. In order for you to implement anything that I'm presenting today or I'll be presenting in the future, there has to be a written permission from the firm, the company, and myself to give you permission to use this for your personal tax purposes. Otherwise, it's a disclaimer. Basically, that's it. So yeah, and I always start with a disclaimer just because a lot of people out there, when they listen to tax educational webinars like this or trainings like this, they may go home and might be thinking that this tax idea or that tax idea might be applicable to them. And so they would go ahead and do it and implement it, and it appears to be wrong, for example, because their personal situation is not the same, you see. So it's always good to hire your own tax CPA who can look at your tax situation and determine if your situation could use this particular tax advisor or not. Okay, so again, it's just a disclaimer. And like everything else I've done before, I always start my presentation with a joke. So in this case, there's this IRS agent and there's a taxpayer in a red shirt here. Okay, and the IRS agent says, "I'm sorry, sir, but you may not claim Afghanistan, Iraq, and Libya as dependents." So at any rate, it's like super funny. It just cracks me up. Yeah, here you go. Do you see it? Oh, all right. Now that we got that out of the way, let's move right into the big picture of individual income tax brackets for 2021. Okay. Now, even though we're in 2022, we are going to file our 2021 tax return. Does that make sense to everybody? So when you hear for 2021, it's for the calendar year 2021, even though we're in 2022. Hope that makes sense to you. So if you remember, in the previous presentation, I showed you this colorful individual income tax bracket table. Okay, so it has 5 columns. Over here is a tax rate. And then your filing status, if you file as a single person, this is what you're going to be using. Okay, if your AGI or taxable income, I'm sorry, falls between this number and this number, 9,951 and 40,525, then you'll be subject to this tax bracket here, 12%. Anything below 9,951 is being taxed at 10%. Anything above that number is being taxed at 12%. Okay, and if you happen to make $40,526, for example, okay, that one extra dollars, okay, is subject to 22%. Hope that makes sense to you. Now, if you're a married couple and your filing status is married filing jointly, then you would use this column over here. And if you're married and you want to file separately, then you would use this column over here. And then last but not least, if you're a head of household, then you would use this column over here. Does it make sense to everybody the way the tax table works for each type of filing status, if you will? Okay, so it's very important for you to know which status, which filing status you fall under, and then you go look up the corresponding table according to that. And then previously, I also talked about the capital gain tax bracket for 2021. So here it is again. In 2021, you're going to have 3 brackets, 3 tax rates, 0, 15, and 20%. Okay, again, your tax brackets depend on your filing status. In this case, if you're single, your tax will look very different for a certain type of income, capital gains income, compared to a couple who are filing jointly, okay, and so on and so forth. So all of this was covered previously. You could go back to episode, I believe, 6 or 7. And then previously, I also talked about the 6-step process. And that's just my 6-step process. Okay, other people may have other steps, but like for me, generally, I have 6 steps when I prepare my client's tax return. Okay, so first step, just to reiterate, is you got to determine the filing status. In this case, these are the filing statuses that are available. Okay, there are 5. 1 is single, married filing joint, and then married filing separately, head of household, and qualifying widower or widow. And then step number 2 is that when after you determine your filing status, then you figure out what your adjusted gross income is, AGI, or I call it AGI, AGI. So that's step number 2. And then next, you will determine what deduction, if you will, right? The deductions, whether it's itemized deduction or standardized deduction, which one would give my taxpayer, my client, a higher deduction? That would be step number 3. And then step number 4 is that now I have that taxable income amount. Then I go to the tax table and then I look up the tax table that I just showed you. Okay. And then number 5, I will subtract from that tax liability any amount of tax withholding or tax withheld from the W-2 of the client. And then I will determine if there are any available credits that this particular client may be eligible to take. Okay, so that's step number 5. And then step number 6 is to look at the results and see, hey, if this is a negative number or a positive number. If the number in step number 6 is a positive number, that means my client owes the IRS some money. And if it's a negative number, then they get a refund from the IRS, right? So I talked about that previously. It's pretty simple, right? Okay. So today, I want to talk about a little bit. A lot of people have asked me, well, I've seen a different word for AGI, and it's called MAGI, M as in mother or mom. And I will get into that a little bit later, probably after this slide or so that you can distinguish between the difference between AGI or AGI, adjusted gross income, or MAGI, MAGI, modified adjusted gross income. Okay, so now you have your gross income, and let's just say it's a very simple tax return. The taxpayer just has a W-2, right? They go to work, they get a W-2 at the end of the year. So these are the items that will impact AGI from gross income. Okay, so you have gross income, and then add to that gross income or subtract from that gross income the following items. Number 1 is alimony payments. Alimony payment is when a person, let's say a wife, receives some financial support from her ex-spouse. That's called alimony. She's receiving money from her ex-husband, and therefore that income is basically part of her gross income. She has to pay tax on that income. Now, prior to 2020, it was 2019, there was a brief period where the spouse had to include that as income. And then in 2020, that alimony income was no longer a taxable income item. Okay. If the divorce decree was signed before 2020, pretty much, okay? So at any rate, so now we're in a situation where the alimony is no longer deductible by the payor and is no longer a taxable income item for the payee. Does that make sense to you? So the laws change all the time, okay? But these are some typical items that would impact a taxpayer's gross income. Educator expenses for those who go to school and teach, like be a teacher, right? And so you can take like your educational expenses, like if you're a teacher at an elementary school, and you have to spend $200 in buying, I don't know, like stickers for your students, right? Well, that $200 is now a tax write-off on your personal tax return being subtracted from your W-2 income. Now, you cannot deduct $2,000 worth of classroom expenses, but the IRS may give you, in this case, $250 max for the year, right? So with the kind of inflation that we're seeing nowadays, I don't know how much, what stuff you can buy with $250 for the entire year, in a classroom of 25 students. But, it never hurts to ask your tax preparer to take that in consideration if you're a teacher. And you do incur some teachers' expenses or classroom expenses, okay? HSA, health, excuse me. HSA is HSA stands for Health Savings Account. And that basically a deduction. So let's say if you put away $1,000 into your HSA account, you can set it up, and depending on what kind of HSA you set up, and it could be a very high deductible kind of health insurance plan. It could be just a regular plan, depending on what kind of plan you set up. But generally, you can get a deduction from your gross income for that amount of money that you put aside toward your health savings account. Okay. Number 4 is your moving expenses. Number 5 is your self-employed, SEP-IRA, or simple IRA, or qualified plans. Now, if you're a self-employed person and you have to buy health insurance for you and your family, well, guess what? That expense is also a deduction from your gross income, okay, in arriving to your AGI. And then, of course, if you have a Schedule C, when you are a self-employed person, you file a Schedule C, and therefore you have to file pay self-employment tax or payroll tax, right? So these two terms are used interchangeably, self-employment tax or payroll tax. And 50% of that is a tax write-up. And so now you could deduct that 50% of your payroll tax, self-employment tax, on your Schedule SE from your gross income in arriving at your AGI. Student loan interest, for example, is also another item that will impact your AGI. Let's say you borrow money to go to college, and after you are done with your degree, you graduate, you go to work, and every year you get a statement from the school, not from the school, but from the firm that administers your loan, showing you how much in student loan interest that you paid during 2021. Well, that is also a tax write-off as well on your income tax return. And basically, it's just a deduction from your W-2 income. What else? Tuition and fees could also impact your AGI as well. So these are the 9 items. So if you want to take a picture of that, or write it down so that you know what these items are that will impact your AGI. So typically, some people would ask me, well, I've heard of this term called MAGI, right? What does it stand for? Well, MAGI is modified adjusted gross income. And usually your AGI equals your MAGI. So your AGI equals your MAGI. It's just like, oh my gosh, there are just so many abbreviations, right? MAGI, AGI, okay? So your AGI and your MAGI, so your AGI typically is equal or the same as your AGI. They are very identical, except there are, when you have a certain credit or certain deductions with limitations, the rules will ask you to figure out what your MAGI is in order to determine what that credit is, or the limitation of that credit on your tax return. Am I confusing you yet? I hope not, okay? And that's when you have to do an extra step in figuring out what your MAGI is, okay? But you cannot determine your MAGI until you determine your AGI, right? AGI. So first you determine what your AGI is, and then you, for some taxpayers, not all taxpayers, for only certain taxpayers who are eligible for certain credits or certain deductions, which I will get into later, they would have, or I, as a tax preparer, I would have to go and do an extra step to determine what the MAGI number is for this particular taxpayer. And that's the reason why when your tax return is a little bit more complicated, for example, let's say if you work as a self-employed person and you want to figure out what your IRA deduction is, or your SEP IRA contribution should be, then I would have to do this extra step right here, right? I have to figure out what your MAGI is to determine what that number you can contribute into your SEP IRA. Does it make sense to you? Okay. And that's the reason why the tax prep fee is a little bit more expensive, because there's this extra step that the tax preparer has to do in order to complete the job. Hope that makes sense. Okay. So like I said earlier, typically your MAGI equals your AGI, except the following circumstances. Okay. And these are just some of the items that would be added back to your AGI in arriving at your MAGI. Okay. For example, the student loan interest, the 1/2 of self-employment tax, right? The tuition expenses, the passive loss or passive income, IRA contributions, non-taxable Social Security payment, just the non-taxable portion, okay, not the taxable portion. So if you have a question about Social Security payment and how that works, you may enter your question on like down below here, where you can put your comments here, and then I'll get into this at a later training. Foreign earned income exclusion is another item. And let's see, what else? Oh, tax exempt interest. Okay, well, tax exempt interest is not a taxable item. So let's say if you have gross income and then you have $10 of non-tax exempt interest from your bond portfolio, for example, okay? So now you have your AGI, right? So let's say if you make, for the entire year, you make $100 of W-2 income, and then you have $10 of tax exempt interest. So now your total AGI, adjusted gross income, is 110, right? Okay. So now you want to take certain credits, and that credit requires you to determine what your MAGI is. So now you have to basically subtract, okay? Not subtract, but you know, like how you have $110 of income, but because it's a tax exempt bond, so you exempt that income of $10 from your AGI. So now your income is 100, right? Basically your $10 of bond from your bond portfolio is not taxable, okay? But now because you have to figure out what your MAGI is, you have to add back that $10 to your $100 of income. So now your MAGI is 110. Does that make sense to you? I know it's like, it's convoluted, right? But just remember that there will be times when you have to figure out what your MAGI is, right? And these items right here, these are the typical deductions that are typically needed to be added back to your AGI to derive at MAGI, modified adjusted gross income. It's a very long list, I know. Rental losses, same thing. And we can get into this rental loss which I think we kind of talked about it, a $3,000 loss every year. I think previously in previous episode, but basically you have to add this back, increasing your MAGI. And then if you have publicly traded partnership loss, on your K1 form, then you also need to add this back as well. So basically, the bottom line is this. The IRS really wants you to basically limit your ability to take certain credits, or by making you add back certain types of deductions, thereby increasing your MAGI, your modified adjusted gross income. That essentially is limiting your ability to take certain credits or certain deductions, if that makes sense to you. Like the whole rationale behind all these adjustments, so on and so forth, is they go, okay, well, we want to level the playing field, if you will. If you, the taxpayer, are going to take certain kind of credits, we're going to make you increase your income so that you cannot take a maximum credit. For example, if you're, after you make that adjustment and your income is over than, what they think your income should be, then your credit would be a lot less than if you didn't do all these adjustments. Does that make sense to you? The rationale behind all these very convoluted ways of getting to your MAGI. You know what I'm saying? Okay. So, and yeah. So this is when things are getting a little bit more complicated, from a tax preparation standpoint. But other than that, it's a very simple process. It's a 6-step process, except when you have to take certain credits or certain deductions. Okay, so just remember that. So like I said earlier, why there's a need for you to distinguish the difference between AGI from MAGI? Well, first of all, some deductions are reduced by a percentage of AGI until the deduction is 0. For example, the medical itemized deduction, okay, which is subject to 7.5% of AGI in 2021. Charitable contributions, 50% of AGI for private foundations, veterans, organizations, fraternal societies, cemetery organizations, for example. Okay, so there's a 50% limit and there's a 30% limit, depending on what charitable contribution to which charities you're making your charitable contribution to. Okay, so it's not a straight 30% or a straight 50%. You have to really know what kind of charitable contribution you're giving your money to. Okay, so it's quite important. HEI is also important because of the credits, like I said earlier. For example, savers credits. This is the credit for people who open an IRA account. Okay, so the government really wants to encourage taxpayers to save for their retirement. So to encourage them to do that, there has to be some kind of financial motivation, right? And that financial motivation is this savers credit. Also, another credit is the earned income tax credit. Excuse me. That's also are subject to AGI. Now, let's get into a few credits that are limited by MAGI. Okay, number one is the lifetime learning credit, which is an educational credit. Basically, when you go to school, college, in this case, you can get a credit, okay? And you can take a certain credit, for the entire time that you attend school. That's why it's called a lifetime learning credit. And it's limited. And the way that credit is computed is by basing the credit on the MAGI, not the AGI, not the AGI. it's on the MAGI, okay? The modified adjusted gross income. Tuition payment deductibility is also another one that is based on MAGI. The Roth IRA eligibility or the IRA contribution deduction deductibility also based on MAGI. Now this one is for people who have who are in retirement age and they have what we call an IRMAA, income related monthly adjustment amount. I know it's a really long word, okay? But the short abbreviation for this is IRMAA. It's a Medicare related headache, which I will get into later on for those of you who are now retiring and who have to pay for Medicare, who rely on your Social Security income to live in your retirement. And you have to be really careful about the way your Social Security income is being taxed, the way that your Medicare premium is being charged to you, which is really pretty much based on your IRMAA, okay? And yeah, it could be a big headache. And then adoption tax credit is another one that depends on MAGI in order to be computed accurately. So remember the 6-step process that I talked to you earlier, okay? In step number 5, remember step number 5? You're gonna have to determine whether or not you are eligible to take any credits to offset your tax liability computed in step 4. Remember that? Okay. So I'm going to be spending a lot of time today talking about credits because I know previously I talked about, step 1, step 2, step 3, and step 4. So this is pretty much step 5, okay? Just to give you a heads up. All right, number 1 is the child tax credit or CTC and other dependent credit, ODC. Number 2, child and dependent care credit. All right, so I want to kind of bring your attention to these 2 credits, okay? Number 1 and number 2. One is a child tax credit, CTC, and the other one is a child and dependent care credit. These are 2 different credits. Ladies and gentlemen, they're not the same. They're totally different, okay? And I will get into each of the credit here later on. Number 3 is basically the stimulus payments, right? So in 2021, we still have to deal with the stimulus payment. Why I have to use the word deal? Because it's extremely confusing. Most taxpayers or most of my clients, I don't know about other people's clients, but most of my clients don't remember how much they got from the government in 2019, in 2020 at all. Seriously. I say maybe out of that many clients I have, I'll say maybe 1 or 2 remember, yeah, I got $600 from the government. I got $1,200 from the government. Most of them have no recollection of ever receiving any money from the government at all. Even they got a direct deposit from the IRS, okay? So it's a total nightmare because when you remember the information wrong, remember, and I told you before, garbage in, garbage out, right? If you give me the wrong information, I input that into the return, send it off to the IRS. The IRS will then match up what they have received from the taxpayers. This is what they got on file. And if there's a discrepancy, what will happen? They will issue a notice. And when you, as a taxpayer, receive a notice, immediately you're thinking, oh my goodness, I'm in a panic mode right now. My tax preparer must have been doing something wrong. When in fact, it's the taxpayer who gave the information to the tax preparer wrongly. Does that make sense to you? Okay. So this is an item number 3 here, the stimulus payments, that I really have to like call to your attention, because as you gather your information, it's very important for you to remember how much you received from the government, right? Because it's important. If you put in the wrong number, the IRS is going to issue you a notice. That's the end of the discussion, right? And then you have to spend time dealing with that notice, okay? Number 4 is the Earned Income Tax Credit, or EIC. And then adoption credit, if you happen to adopt a brand new baby or a child during 2021. And then last but not least is the credit for the elderly or the disabled. So these are the 6 typical credits that you as a taxpayer can take on your tax return. So when I'm at step number 5, these are the credit credits that I have to think, oh, okay, is my client eligible to take any of the credits? And then of course, there's just other credits. For example, the energy efficient credit for those who bought a brand new solar panel on the roof, right? Or if they go out and buy let's say an electric car or a hybrid car, for example, right? So that's a different kind of credit as well. Alrighty, so this is what we call the income credit, the child credit, the child tax credit. Let's see if I can. Okay, so let's talk about this first. So this is the child tax credit. So you get it if you have a child, an eligible child, okay? So to qualify for this credit, and so what happened in 2021, during the year, the government started to send out a portion of the credit, basically an advancement of the credit in the form of cash to taxpayers who they thought would have an eligible child, okay? So the way it works is this: half of the credit was paid in advance from July of 2021 through December of 2021. And then the other half, the 50%, will then be claimed when you being the taxpayer, file your tax return. Now, in order for you to qualify for this child tax credit, these are the things that you have to do, okay? Number 1, you must file on 2019 or 2020 tax return. And then in that tax return, you claim a child tax credit. Does it make sense? So let's say in 2019, you didn't have a child. In 2020, when you filed your tax return, you didn't have a child. But in 2021, let's say in July of 2021, okay? You, as a taxpayer, you have a brand new baby, okay? The government would not automatically send you a portion of that advancement to you in July. You have to actually contact them through the website and give them the information. Otherwise, they wouldn't know that you have a brand new baby, right? Okay. But like for those of you who don't do number 1, right? And you don't do number 2, in other words, you didn't give any information to the IRS through their website, then you're not going to be able to get anything in 2021. You have to claim this child tax credit when you file your tax return in 2022, okay? And number 4 here, it says right here, it's basically pretty much you got to live in the US for more than half a year. or you filed a joint return with a spouse who has a main home in the US for more than half a year, and you have a qualifying child who's under the age of 18 at the end of 2021. So let's say if you have a child who turned 18, say in July of 2021, this child will not qualify you to receive a child tax credit. Does it make sense to you? So the child has to be under the age of 18 at 12/31/2021. If he or she turns 18 during the year 2021, and so basically by 12/31/2021, that child is 18 years and 5 months old, for example. Well, that child is no longer eligible for you as a taxpayer to claim that child tax credit. Okay. And then of course, this person, this child has to have a valid social security number. And of course, they need to make a certain income limit. They cannot make more than a certain amount. So I hope that makes sense to everybody. The way this child tax, again, is a very convoluted way. But again, the government's intention is a very good one. They just want to give the cash to the taxpayers during 2021, so that they, taxpayers have cash to take care of the kid.